Hey guys, wanted to do a little update on the S&P 500. So this chart goes back about to 2001. So what is that? 23 years, 24 years back. So as you can see, this top red line, this is basically a channel that the stock market has moved up into, down below, up here. We have this bottom line here that really goes only halfway between the deepest drops we've had, this one here, right? And so that's just a channel to show you if the market can be overexcited, stuff like that. Here is one bear and bull phase. That was the last one, which happened around 2007, 8, 9. Before that, we had a similar one, but I don't have that data here. So basically, we had the crash here. We had a big bull market, big crash here. That's all kind of normal stuff. Forgive the music in the background, by the way. I can't be helped. Yeah, but pay attention to how this blue line here, when we went to the top and we went into a bear market, it was able to go basically even more than twice this blue line down here. So now let's just take a closer look at what's going on. So, yeah. So here we are from that giant crash, and then we're moving up and up and up and such. This orange line here, it's quite important. This orange line is basically representing how much spendable money is in the world economy, not just America or wherever you're at, but how much spendable money is in the world economy. It's called global net liquidity, right? The more spendable cash that's available in the economy, which means interest rates are lower, more loans are being able to be had, the Fed is loosening policies to get more money out there, more spending, stuff like that. That's what this represents, this orange line. It could also be called money printing and money tightening. It could be called that. So let's look at how this red line, this top red line, has been dealt with since around 2008 when the big crash occurred. So basically, we have something that's called ultimate fear going to ultimate exuberance. Some people call it irrational exuberance. And that's when, if you get ultimate fear and then things start climbing, the human emotional system, basically, the longer things climb, the more people think they'll climb forever. That's how people are geared. And so what that'll cause from such a deep drop is it'll cause people to forget about the bad times in the past, and they'll just think, oh, things are just going to go up forever, right? And so that's why, coming out of that real fearful drop, you have this staying up above the red line for a nice extended period of time. So this extended period of time would be kind of normal coming out of such a deep drop. But then after all that super excitement happens, then we get a little correction that brings back to mind the normal fear of things that can happen, things that can go wrong. And so from that point, we went from that super fear to that super exuberance, super joy. And then we had the reset. And then after that is when things will kind of normalize. So in that normalized phase, and this is all the dark price line we're talking about. We're not talking about the orange global net liquidity yet. And you can see we're kind of fitting inside of this range, right? The range goes up to the red, it comes down to the blue, goes up, down to the blue, up, down through the blue during the global pandemic announcement. That went really deep. But then up, down to the blue. This is just you can see how this range does make sense. It's not just a drawing that I made up, right? All right. So we discussed why this would go up near the red so easily, stay up for a long time. Then we reset. We get into a more normalized market. In the more normalized market, now let's just put this behind us. We've already talked about it. And let's zoom in a little bit more. So here we are resetting the market here, like we said. And now we get into a more normalized market where it gets up to this red. Then people get exuberant, overjoyed for a time, and that goes up to this red, and then it crashes, it resets, especially down to this red line quite a bit. And what often happens, by the way, what often happens is first you have an irrational top that touches, as high as possible, and a reset, and and we can expect another big crash, or a big correction like this to come. But often, first you'll have the big rise touching an irrational spot, and then you'll have a crash. And then before the bigger crash, you'll often go back up again and get the real bigger crash right there, right? And of course, in the next phase here, it got interrupted by the global pandemic. The global pandemic being announced really crashed us hard. And so how did we get out of that hard crash? How did we handle the global pandemic to make sure we didn't go into a really super bad crash, right? Well, we handled that by printing money. And so that's why you see right about this time, when the global pandemic was announced, you saw that we printed and printed money for people to survive through the global pandemic. People who weren't able to go to their jobs, and people that got checks in the mail. All that stuff happened by the government. That was part of printing money. So that's why this makes sense. Look at how far above the red ultra zone, that zone that doesn't normally get touched. Well, we were able to do that through printing tons and tons of money into the economy, and that was able to put us above the red zone. So this is a freak of nature, this being above the red zone here, that it went so far above the red zone. That wouldn't happen in a normal economy where we don't have a global pandemic which causes overprinting, right? So after the overprinting, they tightened up everything. The Fed, they tightened up, they raised interest rates, they tightened everything up, they took back money they loaned out to the banks and all that stuff, right? The too big to fail banks. And so money basically disappeared from the economy. It was harder to get loans, and people who can't get loans can't spend as much, bounced up, it went down. So basically this is the reversal of money printing. This is money tightening. And now today we're at the lowest low of money tightening. Really low, right? Back here's a low that kind of touched our blue line. Here's one that got near it. And now we're at an ultra low. So we're at an ultra low of money available in the economy at a time when we have an ultra high of the stock market, the S&P 500, right? So in the S&P 500, we went up. We did go up and touch the red and reject. And now we're climbing up into that red. We're trying to stay in there for a bit. So the moral of the story is, when we look at this really long chart, is that this red isn't normally we're not gonna normally have a lot of time spent up there toward the end of the market. So the moral of that story is that this might be more of a time of taking money off the table rather than a time to put more money into stocks and stuff like that. And, we have to be concerned that, we haven't yet had one of these, right? We haven't had one of these yet. Let's see if we can fit that in there. We haven't had an actual real bear market since this time back here. A real bear market falls down twice as far as this bottom line here. All we've had is bounces down to this blue zone. Look at that, to the blue zone. That's all we've had. And basically the market's been held up very obviously by money printing, right? As money printing rises, the stock market rises, yeah. And then here we have an ultra low and an ultra high on this right here. And we need to be aware that these things do happen to really correct the market properly, right? But we've been printing money to keep the market super high. So even if we just get another one of these, which many speculate we would actually get something twice as far down because of this ultra crazy rising phase that just never stopped. But if we just got a regular correction down to here, well, what would that take us to? And could this be that beginning of getting into that really irrational space during a time when we don't have ultra money in the market, during a time when we're not at the beginning of an ultra phase that went from super fear to super excitement, right? So could we be getting up here in a time where the big fall, the big correction, which is actually normal in markets, it's normal, but we haven't got it because, well, our government and the big banks or whatever, they just don't want it to happen. They don't want that time to happen. They're really afraid of it. When this happened, they were scared to death. They were getting together in giant meetings. They were getting together and presenting to the U.S. government that they should be too big to fail. And so they were getting bailed out, all that good stuff, right? And they were scared. Like if you watch the movies of that represent what really happened during this time, they were scared to death. They were like, is it all over? Is the global financial system or the American financial system all over? That's the stuff they were talking about. So since then, they've found a way to just keep the party pumping. But eventually, these things just cannot last forever. It's just the way of the balances of power, the balances of finance. Everything finds its balance eventually. Just look at the short term. Find its balance, find balance, find balance, find balance, find balance. And next, we're going to find balance here eventually, right? But eventually, in the bigger picture, you find balance. And that's when something this deep comes. So if something that deep comes, and I'm just saying, we're up near the red line now. Maybe that's the preparation for something. Maybe it's just a preparation for this. But be aware that maybe it's the preparation for twice as far down. So if we had a twice as far down scenario, let's look at how much painful that could be, right? So we'll just zoom in a little closer here. Let's do it about like that, right? So if we just have a normal fall from this location up here, then it looks like we can get down to, I can't read that too well. I guess I didn't print that well enough to get the where it's really readable. Let me zoom in, I guess. Yeah, I don't have good resolution, do I, on that? Let's see. Let me bring it back so I can see if I can see what that is. Looks like we got 5, 5, 4, 4, 4, between 3 and 4. So maybe this is the S&P 500 just under, what is that, 4,000, right? This right here, maybe 3,500 S&P 500. So a drop to that, oh, well, actually, no. The most reasonable drop that we keep doing, right? The most reasonable drop, that would only be to about here. So that's about 4,500, right? About 4,500. But the thing we were talking about is if we have a big reset, then that could be a twice as far type of situation from this blue line. That could be down to here. Something you couldn't even imagine, I suppose. You probably think that that'd be pretty ridiculous. But yeah, that one goes to over here somewhere. That's looking at, and I'm so sorry we can't read these. I should have tried to make those easier to see. But here we got a 23 to a 27. So we're talking about dropping down to 27, in a really big drop scenario at the very least. That's just if we copy this. So it's not possible, is it? We did this before. And a lot of people are saying, well, we'd actually go twice as far as that. I don't even want to see what that price looks like.
Likey. Comment. Subscribe now.